All right, guys, welcome to this video. Thank you for watching. Thank you for joining us. In this video, it's going to be talking about risk taking and risk control. I have a list of things. I'll read them out for you. Risk control, risk framing, ways to frame risk taking and risk management, and the effects of market movements on traders and human beings, of course. And on the second page, check this out. We have more mental hacks to help balance your health and your perception of risk taking and trading. I'm going to give you guys a few of those, and we're also going to have a brief discussion about risk reward later in the video. So stick around for that. If you enjoy this content, you can show your support for the channel by clicking on the very first link in the description, and you can write a comment to let us know what you think of this as well. If you like the video, only click the like button if you like it. That's it. Thank you for watching. Let's get on with it. Today, guys, it is Thursday, September 15th, 2022. I'm making this video. I thought it was relevant because in the last few days, I've been in a spot where I was starting to feel a little bit mentally exhausted from risk taking. Now, I was potentially needing to work a little bit on my framing of my risk taking in trading. In the past, I have not been as experienced as I am today, so I felt like now would be a decent time to talk about some of these things to potentially help new traders get around this or have some sort of a reference from which you can understand how taking an absorbent amount of risk in a short amount of time is really impacting you and what you can do to help yourself from making bad decisions in the short term. And let's talk about it. This week, there was a CPI number release and the market moved very drastically. Okay, so I'm filming this here. It's a Thursday. You're probably watching this at a later date, but the CPI number was released on a Tuesday, and we're going to go overhead and look at the chart now, and I'll show you guys what that was. So for example, I'll look at the chart for the NASDAQ, right? So here's NASDAQ futures, micro NASDAQ futures. This drop right here on the screen is a drop of about, whatever, 1,000 points. Let's say it's 1,000 points in the NASDAQ in total, okay? If you do not have any connection to the markets or understanding of how markets work, then this drop means absolutely nothing to you, okay? Now, some people will say, if you are a day trader, this drop also means absolutely nothing to you. You know, it doesn't bother them that they missed the bulk of the move because that's not really their trading setup to begin with. Okay. Now, let's take it a step further. I believe that in trading, it's important to understand multiple time frames of how the market operates. Understanding the market, even if you're a day trader, understanding the market from a swing trading standpoint, as well as a perspective of a longer term risk manager, portfolio manager, and from an institutional mindset. So I like to think of the markets that way when I'm day trading as well. So I take my setups, but I filter out my setups based on bigger time frame and institutional positional ideas that are confirmed with, watching how the market is trading in real time. And that'll confirm if those ideas are valid. And maybe you even have some longer term positions on in the market, which means that you do have some exposure, some long delta exposure to the broad market. If the market drops 1,000 points, your portfolio is going to be impacted. And if you don't have necessarily the proper framing around that and around how those positions are meant to be managed, then you are going to be emotionally impacted by this drop right here. So I honestly think that people who say, oh, this drop doesn't bother me, whatever, I think they're bullshitting you, because I think anybody who engages in markets, who's traded the markets for a long enough time, knows about how the emotions of human beings are greatly impacted by the price movements in the market. This is the argument that I'm trying to make, is that when a move like this occurs, the market changes. The way participants trade the markets, it changes when this happens. There's a lot more fear that happens. Certain setups that were working potentially for the last few weeks, maybe the last couple of days, are no longer working. The market just totally changed the way it's trading. Just on one news reaction, traders are now emotionally driven and the market has changed completely. So the basic point of this is that I want you guys to understand that markets and the movements that markets make based on X, Y, and Z news reaction, the Fed, whatever it is, it affects many people on an emotional level, and that will affect the way the markets trade. It will affect you as a product of that as well, because you're one of those traders. So what I want to follow this up with is probably the most important takeaway from this video, and that's talking about framing. The only thing that can save you, I think, or at least, potentially save you from making these lower quality decisions that are driven by emotion and fight or flight, is your ability to use your higher brain functions to have a good framing of your decision making process and why it is that you choose to take certain trades and why it is you choose to not take other trades, and basically understanding your decision making on a very high level. If you don't have the proper framing around your trading, you're gonna get swept into these moves. You're gonna get absolutely destroyed emotionally from the markets over time. So normally let the news play out. This is what I do. And later on, I'll come back and see, how the market is trading around that. Where did the volume go through? What are we doing now? Where are we positioned contextually? And, where's the price discovery? What are the chances of consolidating? Where's the market position? All this stuff is important to my decision-making process. But the thing is, there's also a high probability, especially when it comes to these big macro events, what I've noticed is that they can cause the market to trade like absolute garbage for many, many days in a row, especially around the Fed. I've noticed this in the past. Whenever there's Fed announcements, sometimes the market trades in a certain way that is very bizarre and different for a few days after the Fed announcement or even before. It's sort of like a waterfall current effect where the initial reaction to that kind of spills over into the next trading days, and the market doesn't really return to what would be considered normal market activity until a few days after that. Or potentially there's just something bizarre with the market context that is not lending itself to the opportunities that you're comfortable trading normally. So for example, this week, we had CPI on Tuesday. I traded Monday and Tuesday and I had some pretty good trades, and I might do a trade review video on those. And then after that, I noticed Wednesday, the market was trading like absolute dog shit. And today, Thursday, I decided to even just take the day off because I had a feeling that the quality of opportunity based on what we're seeing is just not really fitting for the way or for the opportunities that I'm scouting for right now. So I decided that I was not really ready from a mental capital standpoint to get up Thursday morning and just hit the market again because I thought that it was just not really going to do anything anyways. So I decided to take that time to rest rather than do the whole rat race bullshit and get up at fucking 8 in the morning and trade like everybody else does, looking at the market at 9:30 in the morning. Because of experience, that's the only way that I was able to do that, because I know my setups well enough. I believe that my job was to wait on the sidelines and just wait for the opportunities and just continue to scout out the opportunities. And by the way, most of the time in trading, guys, that's what you're doing. You're waiting around for good opportunities, and most of the time you're not trading. You're simply waiting, scouting opportunities, and looking at what the market's doing. All of this ties into the effects of market activity on the people that watch the market and on the traders and institutions that are engaging in these markets every single day. You have to put it into perspective. As a human being, you have a limited capacity for processing information. From the moment you get up in the morning to the moment you go to sleep, you have a cup. When you wake up, it's full with energy, and then as the day progresses, the water in the cup decreases and you lose your energy because you're expending it on doing certain things. So, trading, guys, requires a lot of mental capital for planning trades and all that stuff. Now, what can happen is day after day after day of trading and risk taking, you become less able to use your higher brain functions to keep you out of trouble from taking lower quality trades. You get tired and you don't feel like doing the work anymore. And what happens is you start to cut corners in your decision making. You might have stopped reviewing your trades for a couple sessions, or you might have taken a few trades that you didn't plan and you didn't realize you did that because you were so kind of exhausted and you forgot that you had to plan them or whatever. Maybe you've been on a bit of a hot streak in your trading and you got a little confident and now all of a sudden you stop reviewing your trades or something. That's gonna catch up to you, I believe. You're no longer using your high level brain functions to qualify those decisions like you normally would be and like you did when you took those trades that got you on the hot streak that you're currently on. You really need to understand that taking high level decisions and planning decisions requires a lot of mental capital and preparation. Trading is mostly about the preparation and work that you do outside of when you're trading. And I want to remind you guys that I don't have to make this video and tell you this stuff, but I believe that it is my job with this YouTube channel to provide you guys some quality content that you can reference for years to come. So if you enjoy this content, you have to press the like button. Thank you. With the whole rat race mentality of every day get up, 9:30 stock market opens, all this nonsense, eventually, guys, it's going to catch up to you. If you're imbalanced in your life outside of trading, if you have other stuff going on, or if you're forgetting to kind of regulate yourself on an emotional level as well as a physical level, it's going to catch up to you, and you will probably start to notice a decline in performance in your trading. And it could be very subtle to the point where after you make the mistakes, it's going to be too late. You're already going to have lost the money. And that's why it's very important to understand this. And this only comes with experience. The only reason I'm making this video is because I've been in this situation right now, which is the situation of understanding that I believe right now the market's trading like dog shit. Maybe not right this second, because I noticed today it started to change a little. It started to open up here. It's Thursday. But in general, after the CPI, I believe the market was trading like dog shit. But the only reason I say that is because I have enough experience that I know my setups, and I framed my setups enough that for my trading, the market is trading like dog shit. Okay? For a non-experienced trader, they still see the market from that thrill-seeking perspective where they say, you know what, I'm doing a combine, whatever, I'm going to show up and I'm going to trade today to prove to myself that I can trade, to prove to myself that I can either be break-even every day or be consistent every day with a profit. That is a thrill-seeker mentality, or it's an ego-based mentality that you're just trying to prove something to yourself that you can trade. The market doesn't care about you. It doesn't know who you are. And in my opinion, again, I believe that the slot machine of the market is not always in a good state to place bets. And what I mean is sometimes it's just literally a 50-50 bet, and you're gonna win or you're gonna lose, or maybe the risk to reward is shit and you don't see that, and you're playing a rigged game against you. Somebody has to lose, and it's gonna be the traders that are caught with their pants down when they're in a state where they're not ready to make good decisions and they're making them anyways, and then later on they're gonna see that they were in that position, and of course, it's too late because they already lost the money. And this will happen over and over and over again. Traders that can trade millions of dollars, it doesn't matter how much money you're trading. If you're not aware of these things, guys, you're going to continue to repeat these mistakes. Mark my words, mark my words. As an experienced trader who knows their setups very well, and who also is very much in tune with themselves and their ability to use their higher brain functions and channel that God-given life energy every day that you have to make sure that you are in the optimal state to make these decisions and follow your plan from point A to point B and not deviate, right? All of that requires mental capital. And the days where your mental capital is a bit lower, you're gonna start slacking in very small areas. And by the time you realize it, it's going to be too late and you will have already lost the money. So what's important, so what I believe is important is prioritizing that mental capital that you have a limited supply of. And this will result in you most probably delaying the decision making, the high level decisions that you have to make. Delay them until you are now confident again that you are in an optimal state to see what is going on and plan your trades and act upon them consistently, okay? And this takes time. I want you out there, if you're a beginner trader and you have this kind of fixed mindset and you say, you know what, every day I can approach the markets. I see traders who post these profits every single day. They're consistent. You need to understand that even those traders are going to reach a point where their mental capital glass of water is going to be lower than it was the previous week, the previous 2 weeks, the previous 3 weeks. And if they do not have the ability to understand that they're not in the same state that they were, for the last few weeks when they were on that consistent streak, that's number one. If they don't have the ability to realize that, they're going to make a mistake. And number two, if they don't have the ability to realize that the market has changed and they're still doing the same thing, they're also going to pay for that as well. And that's why you often hear about the same old pattern. Traders, they have these winning streaks and then all of a sudden it's over and now they can't make any money anymore. What the hell is happening? What the hell is going on with that? A lot of it is psychological and about how you frame things. And if you don't have that mental energy, you're not going to frame it. There's been some studies on this. I watched a few videos on it and they say that the part of our brain, like deep inside of our brain, is responsible for like our very basic cognitive functions. And one of those is like the fight or flight system that's responsible and reactive to life-threatening events and risk events, right? And what you have to understand is that if you have not framed risk events using your higher brain functions, then every single time you engage in a risk event, you're going to be activating that fight or flight response. And that's going to cause your heart rate to increase. It's going to cause like that primal instinct, that survival instinct to come out of you. And you're no longer thinking rationally. You're no longer understanding, your decision making from a high level anymore, because you simply do not even have the framing in place to understand, your plan and what it is you're doing. You're basically relying on that fight or flight, and you're just going along with the roller coaster, right? So whenever you see traders that posting these, okay, today I made 1,000, today I lost 2,000, and every single day they make a video, and they're saying, oh, I'm happy today, I'm sad today, whatever, because I lost or I won. Those traders do not have a high level framing for their strategy, because they're always up and down, and they're basically fight or flight. They're engaging that dopamine reaction to their trading. And in reality, this is a perfectly normal response, because it's absolutely human. And what I want to finish this point off with is that over time of trading, engaging in risk activity, and you're exhausting your mental capital, basically trading every day, you're going to reach a point where your higher brain functions are they need a rest. They need a friggin' break. And your fight or flight mechanism, your lower brain functions are going to take control, and they can take control. They have no problem taking control, because, at the end of the day, that's what's responsible for keeping you, alive, right? So they're always on, technically. So you can still trade. You can still trade the markets without using your higher brain functions. It would be the equivalent thing as to just mindlessly going to the casino and pressing buttons on the slot machine just because you like the flashy lights and it's dopamine reaction in your brain. Like scrolling TikTok or Facebook videos. It's the same nonsense. So you are extremely vulnerable when your mental capital glass is lower and you show up to the market and look at what it's doing. You need to understand this. Okay, let's move on now. All right, guys, in this next section here, we're going to talk about different ways to frame risk control. And I want to just give you guys a few ideas for how you can improve your ability to perceive risk as a trader. And it's going to be unique for each one of you, because each one of you has a different risk tolerance. And that's something that I talk about in another video that I did last week or 3 weeks ago. So go check out that video too. I'll put a link to it there. When it comes to risk taking in the markets, right? So you're looking at the markets and there's a bunch of flashing numbers on the screen like this. And after a while of trading, you can become desensitized to the risk you're taking. That's why it's very important to frame it and have a very high level framing of the risk you're taking that is relative to how you perceive that risk you're taking from the start. And that is money. You're risking money, right? So you need to go deep and explore what is your view on money, what is your perception of money, and the amount of money that you have in your trading account, and the amount of money you are risking every time you put on a trade. When you put on a trade and you see the market move up and move down, what is that amount of money that you are making or losing, and how significant is that money to you on a primal level? Basically, so you're exploring your programming of how you perceive money and that amount of money. Now, I don't care what any trader says. They can say, oh, don't look at the money, this and that. If you trade with a high enough amount of money, if you're up or down a certain amount of money that is beyond your risk threshold, trust me, you are going to lose your higher brain functions, and you're going to become essentially a caveman trading, and you're going to be like, oh, I'm making 10,000, or oh, I'm losing 20,000, I'm about to commit suicide. And that's not a joke, and that's why I think this is very important. So the first thing is, when it comes to taking risk, you need to understand the product that you're trading on a very high level. So for example, if you're trading futures, I'll give you an easy example. Let's look at the 5-year Treasury futures contract. Every tick this market moves up or down, the trader will make or lose $7.81 in their account. That's before commissions and any of that, okay? So for example, if I buy it at 5 and I sell it at 5.25, I made $7.81. So now do the math. Let's say you're planning a trade and you want to risk 4 ticks. So you need to do in your head $7.81 times 4. That's how much I'm losing. I found that personally, I'm not really that good in math. Math is not really one of my strong points. I prefer to use a calculator. I prefer to use the computer to do the math for me. So you can come up with little hacks to improve your perception of the risk. One way is using even numbers like this. So for example, let's say I just rounded off to $10 a tick. And I say, okay, I'm looking for this trade setup. I'm risking 4 ticks and each tick is worth $10. Even if it's $7.80, I'll round it off to 10. So I'll say, okay, I'm losing about $40 if I lose on this trade. So the even number framing of the risk right there is, for me, it's been a way to easily sort of calm myself down about the risk that I'm taking in the trade. Now, of course, the risk you're taking has to be in line with your actual risk tolerance and your risk management plan in your trading account. The first thing is you need to be trading within your risk parameters. And the second thing is you have to actually objectively fully understand the risk you're taking on every single trade, so that you are not going to be impacted by any emotional distractions while you are in that trade and while you are managing that trade as it is playing out. Most of you know, experienced guys know that certain trades, most trades, sometimes they take time to play out. And if you're there trying to overmanage it and trying to, okay, I have to scratch it, I have to get back in, scratch, get back in. Again, if that's part of your plan, then that's fine. But if that wasn't part of your initial plan for entry on the trade, then there's no reason you need to be overmanaging it. You just put the trade on, let it play out, and that's it. Try to be creative with different ways to frame the risk you take on every trade, and do it for every single product that you trade. So I did an example there for the 5-year treasury, which was rounding off each tick to $10 a tick. And just those big even numbers are just easier to consume for my non-math oriented brain, right? So for example, if you trade the S&P E-minis, let's say you trade the micros, every point is $5. So that means that 5 points will be $25 for every contract you trade. So for example, let's say you're starting to plan a trade and you're thinking, okay, I'm looking at this market and I think it's a good buy around 3,900. So right away, because I know that 5 points is $25, I already understand the risk I'm taking. I'm already ready. I'm preparing myself for the risk that I'm about to take. Okay? For those about to rock, we salute you. There we go. So it's about that mental preparation. And to do that, you're using your higher brain functions so that your fight or flight brain is not going to be so rattled when you're in that trade and when the market is going back and forth and you don't know what the hell is going on. Okay? And normally that's the way the market works, by the way. The market trades in a way that is counterintuitive, that, traders have to be losing money for the market to move. And it's just, there's money being thrown around everywhere. And eventually the market's going to move. And if you're right on the setup, it's probably going to move in your direction. It's going to go to your target. But how it gets there is going to be in a very weird way most of the time. And if you're not mentally prepared for that, you're going to give into that fight or flight. You're going to overmanage. You're going to cut trades before your targets. Let's go into the next section, which is risk reward. Cutting trades before your targets. This one thing right here, guys. And again, there's certain arguments you can make about discretionary, this and that. But look, you have to think of it, really simplify it to the bare bones of as much as you can simplify it. Let's say you have a 50-50 shot no matter what. Nobody has any edge predicting which direction the market is going to go. If I buy it, there's a 50-50 shot. It hits my target or it hits my stop. Okay? In that scenario, the only thing that you have working for you to become profitable, to be profitable, is a risk to reward that is skewed in your favor. Anything better than 1-to-1. You could flip a coin a million times. If you win $1.10 or $1.01. And when you lose $1 even. Over an infinite number of coin flips or an infinite number of trades, you will be positive by 1 cent per trade. It's not always a 50-50 chance, and price moves are not always random, but sometimes they are. Because sometimes the market is literally just a slot machine and there's no edge. And if you don't know when that is as a trader, you're going to be giving your money to Wall Street, while other patient traders are going to be waiting on the sidelines till the slot machine is broken before they put on their trades. So risk to reward is so crucial, and you can even test this yourself. So for example, a lot of people do those like scalping drills. You'll see if you do scalping drills, if you're scalping for 1 tick at a time, you know this, is that over an infinite number of trades, if you're always trying to go 1 tick, 1 tick, 1 tick, 1 tick in a pretty thin market like the ES, eventually you're going to get run over because your losers are going to be like, I don't know, 3, 4, 5 ticks. And there might be even some scenarios where it just goes against you and you can't get out. And every time you lose, you're losing 5 ticks or more or whatever. And every time you win, you're winning 1 tick, 2 ticks, 3 ticks. It's not going to add up. And over an infinite number of trades, the risk to reward is negatively skewed against you. Another thing about risk to reward negatively skewed against you is a stop order. Think about it. Depending on the liquidity of a market, okay, a stop order actually has a built-in negative expectancy into it because there's a risk of slippage in the stop order, right? So for example, I am risking 1 point in the S&P futures and my reward is 1 point in the S&P futures. If the market goes against me by 1 point, I will stop out for a 4-tick loss or 1 point loss. But there's also a risk that my stop loss slips by 1 tick because, for example, it traded and there was no more bid and then my order traded at the next price. The thinner the market is, the more risk of slippage there is on stop orders, okay? So that means that the stop order is going to trade at the next price, meaning that when you lose, you're not going to lose 4, you're going to lose 5. So there's a built-in negative expectancy into stop orders. If you're not accounting for that in your risk reward, that's also something important. Okay, I would say personally, over an infinity number of trades, the majority of your position, you need to be getting paid on something. At least a 1-to-1 or more than a 1-to-1. At least. That's the minimum. If you're cutting trades before a 1-to-1, over an infinity number of trades, you're gonna be a broke motherfucking trader, a broke ass trader. I'm telling you. Don't be a broke trader. You have to frame it that way. If I cut my trades before 1-to-1, I'm gonna be broke as a trader. I need to be looking for high probability trades that offer a favorable risk to reward. It doesn't have to be an insane risk to reward, fucking 5-to-1. You don't have to go for these crazy trades because, believe it or not, sometimes the easy trades are the ones that offer kind of like a pretty good risk to reward. And then after that, you don't know what's going to happen because the trade is now shifting. The dynamics of the trade are now shifting. So you don't really know what's going to happen after the trade is continuing to play out. So I believe that you should be getting paid on the majority of your trade on your initial target, which is whatever you think the market has to offer that is better than a 1-to-1 currently. Okay, and I know that's very vague, it's very discretionary, but it depends on the setup of the market. It depends on how the market is trading, the condition of the market and all that, because it really depends on what the trade has going for it. Sometimes you could look at the market and you could say, well, you know what? I think this trade has a 1.5-to-1 risk to reward. But I also think that if X, Y, and Z happens, maybe depending on how it's approaching the target, maybe it has a 2-to-1. So it's up to you to say, okay, maybe I'll get paid on half at 1.5 and then I'll let a quarter go to 2. And so you can actually, what I call is like the discretionary level. Like how discretionary do you want to be with your management of your trade? I believe that some of it has to be automatic. No matter what, you have to get paid on something better than a 1-to-1, no matter what. And it has to be probably the majority of your position, actually, when you think of it from a mathematical standpoint over an infinity number of trades. Now, the other thing is a small percentage of your trade, I think, should be left as a runner because over an infinity number of trades, you don't know what's going to happen. There's actually a small probability that the trade continues in your favor forever, which can really greatly skew that risk to reward in your favor even more over infinity trades. So that's it. Certain things to think about, guys. If you stayed this long, you're amazing. Thank you for watching. Okay, guys, take care. I'll see you in the next video. Bye.